Good afternoon, everyone. Welcome to an investment management discussion with Con Michalakis, the Chief Investment Officer at Statewide Super, based in Adelaide. This conversation, if you like, will be free-ranging. I don't know that Con or myself know where it's going. He has disappeared off the. I disappeared off the screen. He hasn't yet left the building, but anyway, here we go. Con, welcome to Investment Management Conversations. On our agenda, we have economics, policy response, market and health, geopolitics, areas of expensive markets, the opportunity for value stocks, contrarians, relative value of fixed income and opportunistic credit, something you and I like to talk about, and sort of where we are with inflation and the yield curve, because that'll impact infrastructure and commercial property. So from an advisor's point of view, Statewide Super is on the approved product list. And when you're looking to use it, you should seek to get accredited. So have a talk to David. He'll put you in contact with Nick at Statewide. They'll accredit you. And then because Con's got a marketing department, what I call balanced, he calls, I think it's active balanced. Anyway, there's a thing in our system that tells you Con does this and we say it's that. You should read that before you go and commit a crime against compliance. So anyway, welcome, Con. Thanks for giving us your time. It's valuable.
Thanks, Andrew. Good to be here.
So the first question on our agenda is economics, policy response, markets and health. And I think there's a couple of things here, and I'm going to let you talk in a moment. But one of the things is we're seeing a lot of cheap money pumped into the economy. That cheap money, it would appear the Fed is going to keep rates low out to 2024. There is talk about inflation. I've talked to the network about the velocity of money. Money supply has gone up, velocity of money's falling. What are your thoughts?
Yeah, so let's break this down. Typically when we have a financial crisis, and you and I have been doing this a long time, you get this, typically there's three things. You have policies, policymakers, economics and markets. And those three basically have done most financial crises since the World War. Okay, we've had some geopolitics in between that. This one's unusual. You have a fourth circle. So you've got economics, underlying economies reacting. You've got markets reacting to policy response, but the fourth circle is driving everything that's been happening, and that's health. That's a pandemic called COVID-19. Now we can sit there and debate how the policymakers around the world have reacted to this, and we would probably agree some of them have done a very poor job, including maybe one state in Australia. There, I nearly gave it away. You know, just could have done a better job looking at this. But the response of this pandemic has meant the policymakers have done, as you've just said, they've pumped fiscal deficit. In other words, they've run deficits in their budgets, which is a surplus in the community using cheap money. They've drastically lowered interest rates, and the central banks have bought financial assets from the private sector, i.e. they've expanded their balance sheets. The net effect of all of this is the following. You've got the economies tracking sideways or going down because of lockdown measures, but bizarrely the markets are going up because there is very low interest rates, and in some circumstances the stimuluses around the world have been pretty decent in keeping relatively things going along. The one thing I would agree with you, and this is an independent view, so the network doesn't think we're collaborating, is that it's very hard to see inflation in this. I mean, basically the market is on life support via government handouts and low rates until the economy bounces back. And I don't see demand pushing pushing inflation up for a while. Now, for a while is what you've just said. It's really a 3-year thing. The banks have said that even if there is a slight uptick in inflation, we will keep rates low. And so we're in this very unusual world where you have somewhat expensive markets in the technology area in particular, going through the roof, while meanwhile the economies are struggling, or the economic outlook is mixed because some economies are opening up, some are closing. It's a really weird mix, and managing through that, and we'll discuss this throughout this this next 45 minutes or so, is you're going to have to think about this tactically, but more importantly strategically, of how you structure your portfolios in this environment. And the world is changing, and I don't know when we come out of the other side, and when we'll come out the other side, what we're going to pick up and what's left. I actually think that when we do the come side, it'll be very similar to what we left. People will want to travel, people want human movement. And as the economies get pumping, we'll see more activity. But in this weird environment next couple of years, because of the damage being done, you're right. I think inflation's a tough one here. I don't think you see a lot of inflationary pressures or margins for that matter.
Yeah, I think one of the other legs which I talked about before is you've got your cheap debt, and a lot of that is being raised by issuing bonds to very wealthy people who are just putting it on the pile. The cheap debt also allows you to go and build more resources, more factories, which then again dampens inflation because you don't get a supply shock because you've got an oversupply and you've got tepid demand, and so you just sort of wallow in this world. And so I think we run short duration on, let's call it fixed interest credit and what have you, because my concern is that if we do get a spike in interest rates because markets think they should put up rates effectively, then it's nearly unexplainable to the retail client. But I think there is no cushion to the downside, if you like. It's very difficult for rates to run lower. I'm
going to be even more basic. Why would you want to lend to any government around the world today for 10 years at rates anywhere between 0.9% per annum down to 0.3% per annum, 10 years. So for 10 years, you are locked in, you're guaranteed locked in, because you know inflation will be somewhere between 0 and 2. You are guaranteed to actually have an outcome less than inflation over those 10 years. And that's the world we're inhabited. Now, bonds has a place, but I like what you just said. And that is, if the yield is that fundamentally broken on long-term bonds, where do you go? You either take credit risk or you take interest rate risk. You can go longer and buy 30-year bonds, but then that behaves like an equity. If you're going to buy a 30-year bond that's yielding 1.4, 1.5, that's called the equity market. You know, at least that can, heaven forbid, that might even generate a profit, or an infrastructure asset. But if you go shorter, you can buy a thing called credit, whether it's a bank loan, whether it's corporate debt, whether it's private lending, and that market is growing. And, you know, the other thing in this environment, we are seeing this market grow because banks are doing their bit in this market, extending loans. I mean, you're an ex-banker, they're extending loans, they're sort of forgiving stuff, they're lowering covenants, but they are constricted in how much they can do. And so the private sector comes in, non-bank financial intermediaries, and offer ideas to companies, small business lending, loans, trade finance, the whole thing. And as an investor, that's good, because if I can get somewhere between 3% and say 6% for these types of lending portfolios, the alternative is cash at 0 and bonds, 10-year bonds, less than 0 after adjusted for inflation. And that's a nice outcome. You're taking credit risk, but you just have to do your diligence on the manager, the type of loan, and how they put that together.
Yeah, so it's certainly, from my point of view, it's an active play. It's not an index play.
Yep.
I'm a big fan of index. We all know that. But one of the issues we have in index fixed interest or in any asset class is duration has been getting longer. And that's because people like the Office of Financial Management have been issuing 30-year debt, and that's dragging the duration out, and that's where the risk is. So I think credit and corporate debt is an active management tool, or an active management activity, as opposed to a black box solution. And I do caution people quite a lot about, oh, you bought this indexed whatever fund. You don't have anything. The debt, well, the instrument is in an index. You're buying it. The risk is actually getting longer. As you said, you'd be better off buying equity, because God forbid they might make a profit at some stage in the future, because there's not much future in, a coupon of 1% or less for a decade. So
I like the credit. I like the short duration credit play. I think that's a very sensible play. And actually, I think the retail sector has been a lot smarter in enabling that area than even the institutional sector, because they're a bit slower. They're actually saying, hang on, I'm not getting a yield. I have enough shares. I've got a property portfolio. I need something different. And the market's reacted and supplied that. The one thing about indexing, I'm going to use the word hate, really hate index bonds. Because an index bond, in other words, buying a passive bond benchmark, if you have more in debt or you're lower credit quality and you're in the portfolio, you're passively buying it. And I like what you said earlier. You want to be active on this and niche and buying quality credit. So you want to buy these investment managers, whether through your MDA or through your lists or through Statewide, and they're saying, what type of managers are they? Do they think like old-fashioned bankers? What's the quality of the loan? At what price am I underwriting? Am I going to get my money back? And can I make a good return on it? And, a better quality lender will accept a lower return. And if it's a really poor quality lender, you probably want to take, you call that special opportunistic credit, where you're getting equity and all these other kickers and covenants where you can take over the assets. But that's really more growth than income, defensive, right? That's a different environment to the stuff we're talking now.
Yeah. So Con, one of our points of discussion here is geopolitics. Trade. Trump feeds into the US election, which I've called the goat rodeo. Goat rodeo has a very specific definition in Southern America, and we might explore that at some stage. The idea of local versus global, local over global, and all of that sort of thing. One of the things I've said to the network previously, and we will delve into a little bit of America, because it is the world's biggest and nastiest economy, and you and I have spent a fair period of time there, is that put Trump over here for a moment and understand that the US Congress, being all those people on Capitol Hill, they basically have the same view of particularly China as the president. Now, whether the president conducts himself appropriately, that's a discussion I'll let you comment on. And what we're seeing around the world right now, post coronavirus, COVID, whatever we want to call it, is that the Europeans are saying, no, we don't like your behaviour. We're getting pushback out of Australia. So we're even getting pushback out of the smaller North Asian countries. We're getting Vietnam, Malaysia, certainly the Koreans and the Japanese. So what are your thoughts on trade, Trump, global versus local, and local versus global?
Yeah, great questions. So as an investment person, I step back. It's not about who wins, who I want to win or lose, who my biases are. That's indifferent, doesn't matter. It is basically looking at this election coming up in the next, 6 to 8 weeks, and who do you think is more likely to win? And my honest answer is, and I think I sent you and Robin a note like was it last week or a couple of
Yeah, the
weeks ago?
JP's note, which
Yeah,
managed to feature on Fox News, that
yeah.
night.
And I think it's really a tight race. And Trump is probably as well placed as he ever was, even in the last election in 2016, to pull this off. His base seems to be holding strong. These are volatile conditions. So I think calling this I just don't know. I really don't know who's going to win. I get the question asked like, who do you think will win? And I say, my honest answer is, I do not know. But whatever you do not underestimate from the previous election that Trump's got a more than an even fighting chance. That's the first thing. The second thing is I get asked is, what do you think the markets will do if it's a Biden victory or a Trump victory? And again, the question is, well, let's wait and see. I don't think you can call that. You saw that when we had the election when Hillary was winning, markets rallied, then she was losing, and it was like, they didn't know who was going to win. The markets tanked, then Trump was winning well, then the markets went up. And then if you remember, all the so-called economists said, Trump's being president, he's going to tank the economy, it's terrible, sell your stocks. Well, he put in incredible supply-side reforms for corporate taxes, and the stock market went through the roof. And again, this is not me saying pro-Trump or pro-Biden. All I'm saying is that is still to play out, and there will be an impact, but I don't think anyone can give that answer other than Trump has a pretty good fighting chance, and this election is going to be just as weird and wacky as the one 4 years ago. On the geopolitics, there is no one in the world today, in any government, that I can see out there fighting for trade. That's a bit scary. So Australia was built on a pretty healthy way to trade around the world. And as you can see with the geopolitical tensions rising, albeit with some pretty interesting behavior by China, right, which is a real concern. When I say interesting as in bad, no one is fighting for trade. And this leads to my idea that we've discussed a bit. Well, it's not my idea, it's ideas that I've picked up. And that is that as we're going into this post-COVID world, we're seeing the development of localism over globalism. In fact, localism is so bad at the moment and good. Localism is good. When it's done well, it's about looking after your community, having your community response on your base, which is fantastic. When it's bad, it's like, oh, we're New South Welshmen. Thank God we're not Queenslanders or Victorians. Or the Queenslanders going, well, we don't want anyone south of the border. I don't know what the Victorians are fighting for. They're just trying to get out of this. Or South Australians, we're not any one of you. Thank God, right? We're shutting everything down. So localism is good when it helps the community. It's bad when we're even fighting across the federation, or we're not talking about immigration, or we're not talking about trade. And managing this construct over the next couple of years will be a big issue. We should never forget Australia's done really well from global trade. It's a great trading nation. It is a small island nation, and this will have major ramifications if everyone becomes too insular.
Yeah, I think I do fear that some of the behaviours that we see coming out of, the United States, I was going to say North America, won't include the Canadians in this, but, the United States is 50 countries under one flag, and we're starting to get that sort of behaviour around this coronavirus thing that, Queensland thinks it's its own country. Who knows what WA is doing? We'll just send them a bill for all the development since Federation. But
yeah, exactly.
Poor old Victoria, they've got involved in security guards who drive moonlight as Uber drivers and what have you. But I do think the challenge globally is people want to be more insular. Governments want to be more insular because it's populist. And that will be detrimental to global markets. I would make a point that 4 years ago, I saw Trump on his last day as a citizen, and I stood in a bar in Elm Street, Dallas, nightmare on Elm Street, and with some guys out of Asia who were very concerned if Trump won, because equity markets would collapse. And indeed, Trump did win. and we were there as Wolf Blitzer was, vomiting into his coffee. And Fox was, their eyes were rolling round and they were foaming at the mouth and what have you. And the next morning we got up and the bell rang in New York and markets took off. So I don't think there's no predictor. I think there's a chance of volatility, but it's the Zimmer frame Olympics that they're running over there. 300 million people, and they found two blokes with Zimmer frames. I would have thought they could do probably a bit better than that, but anyway.
Yeah, exactly. I mean, the choices aren't exactly enticing, but it's their democracy and they have to figure it out. The one thing I will say, what does it mean? I always bring it back. What does it mean for us managing money as an allocator? And that is looking at the trade situation. Trade is veins, it's blood flow throughout the global economy. I hope it doesn't seize up. In that world, if trade does seize up, some of these tech companies that have tax arbitrages and run across the various nations who are highly valued could be in a bit of trouble. And local industrialization or local sort of old economy or things coming back could do well. That has broader ramifications for property and infrastructure. And so this hasn't played out yet, but we're thinking about all these issues. And I get back to the very boring argument. I want to sort of invest in areas that have been left behind since March.
Yeah.
And we'll talk a bit about that later.
Yeah, no, we will. Which leads us into, there's a whole bunch of markets out there that look expensive. So we've obviously seen, we're now in a situation, I wrote a paper, which I think the guys are going to release out to the network, where I think in 2013 or 14, I wrote a paper and I said that the 4 or 5 top stocks in the US were larger than the top 200 stocks in Australia. I just updated those charts. Apple is now larger than the whole ASX 200, and it's considerably larger. And even this correction, it will still be larger. So we've seen a whole race up in, let's call them FANGs, but there are other expensive markets out there. Certainly government bonds, no yield, 10 years, 30-year paper, who cares? Expensive, and growth stocks. And there's talk about rotation, but we haven't seen much rotation yet towards vote. What are your thoughts?
Yeah, lots there to pack. So I'm going to break it down. In our eyes, what's fully priced and or expensive, and in some case bordering on a bubble? Long-term government bonds around the world, don't really want to own them. Highly glamorous stocks that have gone up a lot since March, that are either losing money but have put on multiple $1 billion in market cap, or the promise of making money. So when Tesla has a PE ratio of 1200 and after the 20% fall, it's a 900 PE ratio, as far as I'm concerned, Tesla can fall another 60% and would still be an expensive car stock. Whether you're an afterpay that goes, I don't know, from $9 to 90, it's back to $75. Again, you being an ex-banker, that's unsecured short-term credit financing. Okay, it's done well in JobKeeper, JobSeeker. The world will normalise as the baton passes from the government sector to the private sector. Let's just see how their accounts receivables go.
Yeah,
and I'd be interesting in debtors in days going up.
Yeah, the problem with guys like Afterpay is they're doing really well. But sooner or later, the big guys will check into the game. And it's like taking an M1 Abrams battle tank with a Shanghai. You're going to come second badly. Now, maybe you can sell your business out and what have you, or you can find a big international partner and good luck to them. But never underestimate the capacity of a large Australian bank to completely screw your economic well-being.
Yeah. So I think these glamorous stocks have gone through the roof. Interesting, you said, the five top stocks on the S&P, which is, your Microsoft, Facebook, Google, Apple, Amazon.
Yeah, you got it.
Since they've gone up 3 or 4 times since 2013, 14, maybe higher. The rest of the 495 stocks have been flat.
Correct.
And so the S&P has been driven by, there's no breadth, as the old timers would say in the equity market. Okay, well, one value strategy is to not own the top 5. The top 5 don't own any today and hold 495 stocks in the US that haven't gone up. That's the rest of the S&P 500 market. Now that's a deep value strategy, but I'm pretty broad. That's where the opportunities are in value or valuation. In other words, finding the companies that have okay balance sheets, still have businesses that have not participated in this miraculous comeback, Lazarus-like, since March. And you'll find that there are a lot around the world that have been left behind, and that's where the interest is, right? And, you know, when Warren Buffett's buying in Japan or looking at that, you know, he's signaling as a valuation or value manager that he can't get excited. Now, he owns Apple, right? But that game is played. What is Apple, by the way? That's the world's most expensive margins on mobile phones. Okay, it's got streaming devices, it's got iTunes, and it's got all the other stuff that it's picking up. But like you said, in a capitalist economy, things come in to reduce profit margins. That's good capitalism, right? You get no inflation. So, you know, these things will happen unless things become very localized. Tech stocks are expensive. The rest are, that's where the interest is. But you have to be patient and you have to be medium term. You have to think beyond 4 or 5 years. And some of the managers that you'll like, that you will push into the network. So I like them. They're valuation managers, and rightly so. Some of the folks will look at and go, but they haven't done anything in the last 4 or 5 years. Exactly. If you haven't had FANG or tech, you've done nothing. You actually want to hold your nose and buy this stuff now because it's kind of interesting.
Yeah, I mean, your point around Apple was correct. I mean, Buffett himself said, you know, Warren, they said, Warren, you don't like technology stocks and you typically, you know, done poorly out of them. So why have you bought Apple? And he said, oh, well, it's not a technology stock, it's a marketing company. And he's probably right. Yes. And you know, you once again, I find, you know, where we're looking, where we're talking, because we're underweight equities, because we took the view out of March, even though you got that significant rebound, is the information that you could make decisions on was non-existent. I think the word around here was piffle. So we stayed out. You know, our job in a lot of ways is to protect people's income, because it's taken them a long time to earn those nest eggs, and it's very easy to blow them up. So we were abundance of caution. Now, as you start looking at it and you start to break down those indices, you see these big tech companies have gone really well, and you see nothing sort of below that, and that's unusual. We've seen it. We saw it before coming into the 2000s. I did note, as a matter of interest, last night that I think it's the S&P. The S&P board knocked back the inclusion of Tesla.
Yep.
And what they were saying is, well, you might be excited about Tesla, but then again, back in 2000, we were excited about Yahoo, and the minute we put them in, they collapsed. So, yeah, I think there is value out there, and then the trick is to execute it and the patience, because value managers haven't performed for so long that we can hardly remember when they did perform.
Yeah. Yeah, no, dead right. Just on equities, look, we didn't buy a lot of equities in the recovery. Like yourself, we were somewhat ambivalent, and we think it was driven by these expensive stocks, these momentum stocks going higher. And we're starting to see what that happened. We've seen these retail traders, Robinhood or SoftBank, which is basically a listed tech investment company, buying short-dated options that basically effectively supplies momentum into these tech stocks. Well, if that's not top of the market behavior, I haven't seen anything. There's some really late 90s type behavior. So I actually have a lot of sympathy. You know, the stock market itself is very expensive, valued, and what gets a Guernsey or Jersey, whatever you're from, in this market is it looks okay relative to cash and bonds, but there must be other stuff out there. And I know you're going to shoot me. Other stuff could be alternatives, could be some infrastructure. Heaven forbid it could be gold. I mean, I look at the statewide portfolio. It's got about just under 5% gold exposure via gold companies and some of our managers holding gold. And that's about right. You don't want to go full bore, but that's, again, it's called diversification.
Yeah, we do in MDA hold gold. And actually, we hold precious metals as well. But the gold thing is interesting. We hold gold and gold miners. So just put gold miners to one side. Gold itself, you know, there's a few ways to buy gold. Synthetic gold. What's the point? We hold precious metals through ETF securities in some of the portfolios, and those metals are held in London. But we also hold PM gold, which is Perth Mint gold, and we like that product because, as we say, Clint can take his box trailer over to Perth and pick it up if he can get through the border. So I think you guys added gold as well in recent times.
Yeah. So we picked up gold via our managers and gold stocks, and a couple of our managers are holding physical gold. We're looking at gold. It just went up too quickly, but the idea of holding gold, a little bit of gold in your portfolio as a diversifier, unhedged in Aussie dollars. In other words, if the Aussie, you know, gold set in US dollars, if US dollars fall, gold goes up. If the Aussie dollar were to fall, you'd make money on it. We think that's a pretty sensible play. Again, it's about diversification. It's part of a broadly diversified portfolio, and I think it makes a lot of sense. I think the only issue we've had with it just recently is gold's traded up like it's a tech stock because everybody piled into it, and you know, when the pullback comes, you probably want to get set and buy some more. On Aussie shares, I know you've asked me when would you buy more Aussie shares in the portfolio. We were indifferent. I'll be really honest with you, between 5.5 and 6,200. We'll probably sellers if it got to the mid sixes to sell a bit more Aussie shares. We'd probably be buyers below 5.5. So I don't know, where is it today? It's probably below around 5,000, mid 5,850s. But you know, if we saw the market below 5.5, we'd probably add a bit of shares into the portfolio because we think, you know, it kind of looks interesting. Anything around the sixes just feels a bit like purgatory, particularly where dividends are, and maybe there'll be a cut in dividends. That's why you want to be a bit of everything, Andrew, because it just doesn't feel great.
Yeah, I did. I did a market update. I think JP's, it might be JP's or Citi, they're talking divvies down 30%, which is about 50 bill from memory. And that's going to be a challenge. There's a lot of people out there that are way overweight. You know, the whole I'll invest in Australian shares and I'll get the franking credits, and equities go up if you hold them long enough. My favourite one is, because a few advisors sent this in, a chart of 118 years of equity performance. I keep harping on about that because it's one of the more stupid things I've been sent for a while. You know, investors don't last 118 years, and by the way, the data is actually pretty scratchy. But the big issue for advisors is, and for clients, is those people who are overweight equities. Now the dividends coming down, and in fact, we're seeing that some of the fund managers on the credit side, their yields are actually higher than the dividends that are being generated. But of course, the client's not there; they're in equities. So poorly constructed portfolios is actually punishing the client.
We're finding. I'm going to be boring for 2 minutes. So shoot me if I'm being, but you know, cash is next. Let's call 5-7 year, 7-10 year returns even better. Cash is 0 to 2. Bonds is somewhere between -1 and +1. Equities, you know, when it was in the sixes, it was, I don't know, 4 to 6, 5 to 7. Below mid fives, we can add 1% because you know if it falls over 10%, you can add a % return. Global equities. Emerging markets may be a bit high if there's not a trade war. US equities are fully priced, so they're down to 3s to 4s. Credit. Now, credit looks interesting because you can get somewhere between 3% to 9% depending on the type of investment. And the 9% is more equity-like, the 3% is more traditional fixed income. Property, I don't know, not residential property. I'm not going to play that, but commercial and industrial property, a good core, not highly geared portfolio. You know, it's somewhere in the mid-single digits. Infrastructure is probably getting a bit hit now because it's GDP related, but when things come back on, somewhere between 6 and 8. So you can build a portfolio of mid to high single digits depending on your risk profile, a lot lower if you're in the conservative profile, but you want it diversified. You don't want to be just high yield Aussie shares. High yielding Aussie shares means that you're really stuck in a couple of banks, a telco, a couple of miners hoping they pay up dividends, and then you're really sweating that houses and holes hold you up. Holes in the dirt, houses in the thing, and if it's not, it's not pretty.
Yeah. It's you know, you haven't had the benefit of one of my briefings, but I call the Australian economy the one-trick pony, and I always talk about the hard rock problem, how our miners are going.
Queenstown.
Ah, yes, you would have too. Did I get into them there as well? Yeah,
I'd say Queenstown a year ago. So this is how much the world's changed. We can be in Queenstown and here we are Zooming each other.
Yeah. So, yeah, infrastructure, let's come back to that. Property is interesting, and I'm not going to get into residential property. As I've said for years, that's a mug's game. There is no logic. Move on.
Emotional.
Commercial property is really interesting, and in my last briefing with the network, I talked about retail. Retail has been in trouble for a long time, and I know you know this, if you go to somewhere, if you go to the US and you go to some of the big malls in California, they don't actually have anchor tenants because Westfield was trying to remix away from, let's call it Macy's or Myer, whatever you want to call it, right?
Yeah.
And they tried to make them destination places, and they've done a couple of those, and then they sold. Obviously, Unibail or Damco offered a large amount of money, and they sold out. But malls are in a world of strife, and they're going to have to find their new reason for being. But retail comes in two forms, if you like. Places you have to go to pick up your groceries, your grogs, and your fags, and places you go to pick up fashion items that isn't called Amazon or online. So those valuations are starting to look interesting, be they listed or unlisted. So I'll get you to comment on that. My sort of view on office is, I sort of a bit of a subscriber to the Jones-Lang view that in time, people will want to go back to the office. And I know you're in the office at the moment. I'm not in the office. I haven't been in the office for a decade. You know, I'm sort of linking lawyers here. So office, I think we'll see those really big buildings in CBDs. We will see in Australia a manifestation of America where you have your out-of-town suburban office, and then there'll be offices in town. I think that the big office is under threat. Maybe not in South Australia because not as many people travel so far and for so long. And then industrial, where you need about 4.5 square metres per person in distribution. Those land values and asset values are holding up. and certainly the guys who are as busy as anyone on the planet are cardboard manufacturers. And it's now cheaper to get your dog food delivered than it is to go and buy it from the shop up the road. So, you know, from a state, and of course, State Street, when we talk statewide, sorry, as we talk about infrastructure, you guys have got Adelaide Airport, which is obviously now a Virgin Airways plane parking yard. How are you seeing it? And you've got your unlisted property assets as well.
So the one thing we did in property, and we discussed this very early on when you were diligencing us at Shartru, we only played really core commercial property, core industrial, no development, no B grade. So we stayed lowly geared A grade property. And I think it is so uncertain that you've just described nicely that those properties will be okay. So if you don't have a lot of gearing and you've got good anchor tenants who will have people come back, they'll be okay. I mean, they took a hit this year, obviously, they'll be okay. There'll be a growth of industrial, but playing the quality in. You're going to see a lot of backyard operators doing industrial in the same way you saw a lot of property syndicate doing C or B grade property thinking it was A grade. They're going to be nuked. It's a bit like the strip malls in the US. They're going to be nuked, right? That's an industrial wasteland for them. Then you're going to have to be really smart about how you play it. On the infrastructure, you're right. You've got a temporary dislocation in airports, toll roads, and that dislocation started in March this year. It'll unwind probably in about 12 months. So somewhere between March next year and October, you'll see people come back. Clearly, the Prime Minister's already pushing that the bubbles start opening in terms of travel. That's what we're hearing from our airport exposure, that people want to start traveling from Christmas. I have a somewhat non-consensus view. I didn't discuss with you earlier, so sorry for introducing this, and that is that we had the First World War, which knocked off a lot of people. It was a really difficult, if you read the history books. Then we had the Spanish flu, which then if you survive that, then you've also lost a lot of people in your family. And bizarrely, that gave the conditions for the Roaring 20s. You had the Gatsbys, people wanted to have fun, music changed, dress sense changed, a lot of dancing, people wanted to have fun. The longer this goes on, Andrew, I think we're creating conditions for the aging boomers who want the last more fun trip before they sort of localize, right through to our kids who have missed out. They want to have fun. And I think when this opens up, depending on how governments react to this, we are creating conditions coming out of this for, I'm not saying party time, but you're going to see a Roaring 20s type mentality because people have been cooped up.
Yeah, it's an interesting theory or hypothesis you're building there, because you could add to it 1990, 89, 90. Some of us are old enough to remember that, where eventually the wall in Berlin came down, and Berlin had been isolated sort of out on the end of an arm, if you like, in democracy, with the communists all around it and a wall down the middle. And finally, the Americans sent everyone in the East broke, and the wall came down, and the euphoria drove the German economy and drove Europe for
Hungary, Poland. If you look at what happened after that, and so the longer this stays controlled, the more on the other side you'll see people. But bringing two things: there's a lot of debt in the world that needs to be serviced. If it's government debt and they issue in their own currency, they can figure that out. On the private debt or on some, sort of poor quality assets, whether they're infrastructure or property, they'll get hit. And you don't necessarily want them to be refinanced. They will probably fall. And then how the economy adjusts quickly to the new regime, and as things open up, people want to have fun, just watch this space. I think that's going to happen quickly. In that world, rates may have been priced too low, and your long-term bond rates are going to get hit really hard.
Oh yeah, look, there's certainly a trigger there on long bonds. If it, you know,
Yeah.
you got no downside protection,
Yeah.
and you can just get hammered. You know, you got no. There's no protection on the rate falling.
No margin of
All
safety.
you can do is get hammered out the other side.
And interesting, we didn't mention inflation. We just said that they're just priced so expensive that you know, your 10-year Aussie bond could go from 0.9 as it is today and end up somewhere in 2 years' time at 2%. It's got a 7-8 year duration. You've lost 10-12% on your bond.
Correct.
So your short duration credit idea is good. So I know it's a bit non-concerned, so I introduced you to that last minute, but that's the type of world we're living in. It is going to change how policymakers, governments respond to that, how they allow the lockdowns to open up, and how they allow people to engage in their lives. Because remember, the baton has to be passed from government support back into the private sector. You can't let it fester. I get the short-term government support. I'm a Keynesian. I get that. But it's got to go to the private sector. And then when that baton gets passed, let it sort of, you know, let it open up and let's deal with it. No idea about what it means in terms of COVID vaccine, treatment, virus control. I can tell you this, treatments will get better. Vaccines, who knows? People will adjust to the new norm or a new set of rules. Or people will be absolutely angry with a set of rules and actually protest against it. You're going to see that as well.
Yeah, I think, I think one of the challenges in the United States is, you know, you've got this weird situation where effectively a lot of people who don't have a lot are backing the Republicans who believe in tax cuts for the wealthy. And they're convinced on that. But, you know, that they don't have a lot and they're in a really bad place and they're the first people to lose their jobs and they can't work from home. So now they're down at the mall chucking rocks and I don't condone that sort of behaviour, but I understand it. And, you know, the longer this lockdown goes on around the world, the closer we get to rock chucking elsewhere.
Yeah, and so that's what it is. As I said, my only caveat to that is hopefully trade doesn't get out of hand.
Yeah, I agree. Well, Con, that sort of brings us to the end probably of our agenda of conversation items. I thank you for your time. We really appreciate that you can spare us this sort of time, and I'd implore everyone who watches this to get in and understand the statewide fund, because it is run very close to our way of thinking, the Shartru way. For those who have just joined the group, Con was out in New Zealand with us when I did a presentation about the Shartru way. I think that he and I agree on many things, and statewide is an excellent opportunity to place people's money who should not be in self-managed super. And as I've told many advisors many times, statewide, because it's an industry fund, and self-managed super outside the SIS Act. Anything inside the SIS Act is fundamentally flawed because of the 90-day liquidity clause. And if Con had the 90-day liquidity clause, he couldn't invest in Adelaide Airport, which is, and indeed you had a position in Gdansk in Poland, which worked really well for you.
Thankfully, we sold a year and a half ago at a good price.
Yeah, well, that's time in the market, Con, you know that, not timing. Anyway, thanks very much for your time. If people have questions about statewide, then you should ring David, Head of Advisor Services, or ring me. And if it's specific to investments around statewide, I can ring Con, and he's very good at. One of the things about statewide is the transparency between the two organisations. It's something that we expect of all our fund managers, and statewide are very good with that.
Anything you want. The only thing we may disagree on, that the greatest cricket ground in the world is Adelaide Oval.
Yeah, well, you know, what's the difference between South Australians and Tasmanians?
What's the difference?
South Australians can swim. By the way, it was told that joke was told to me by the head of SACA, that's South Australian Cricket Association. If anyone cares.
I've got one not for public consumption, but that's
well, let's not say it here.
Yeah. Thanks, mate. Thank you, Shartru. Really appreciate your support. Thank you.
Thanks, mate. See ya.
Cheers.